All right, guys. Well, happy Monday, an eventful week and weekend as per usual. Um, so before we jump in, I just wanted to say thanks to everyone who jumps on this call every week. We've been doing this for about 3 years now, every Monday, and it's great to see a lot of the same faces. It's great to see a lot of new faces. The reason why we do this is we want to, kind of share what's happening in the market, in real terms, equip you guys with some good market data, some information you can share with your clients. And so just wanted to say we appreciate you jumping on today and trusting us as a resource for some information. Um, so okay, so the President Trump playbook looks a little bit like this, okay? And and it's not really only President Trump. Like if you think of years ago, in politics, they would do a news dump on a Friday afternoon on a holiday weekend. So, like if you're President Obama and there was some news to deliver that may not be the most popular, you might release it at 4:55 on the Friday of Labor Day weekend. That's kind of an old, trick of the political playbook. Um, what President Trump does a lot right now is like typically the weekends aren't that newsworthy, but he uses the weekends to move the markets in advance of Monday and also to gauge public perception. If you guys remember, like 6 months ago, when Bill Pulte, who's the chairman of the FHFA, which kind of regulates like the FHA and somewhat Fannie Mae and Freddie Mac, remember when he floated out like the 40-year mortgage and people were like, not really sure if that's going to move the needle very much. And we kind of share that opinion. That was floated out like on a weekend on, one of like the weekend talk shows. And so what President Trump does, and the reason why I love that Twitter feed that I share with you guys a lot, Kobiesi letter, is they are sharing real-time information. And so the president will kind of float something out on a Friday after 5. And then he might tweet a few other things over the weekend and use that to gauge kind of market reaction. And the oil futures typically open up around 6 o'clock p.m. Eastern on Sunday night. So they've got from like Friday at 5 basically until Sunday at 5 to float ideas and market information and go on talk shows and move the markets in advance of Monday morning's open. Um, so last week was a very bad week in the markets. The bond market, and we'll share this in a minute, was terrible. So hug your loan officer after Friday because it was not fun for us. Rates were up about 0.25% on Friday alone. The stock market was actually had a weak, poor week as well. And so late yesterday, there were some talks of productive talks with Iran. Maybe there's a ceasefire, maybe there's not. But what's the stock market doing today? Does anybody know? It's up 916 points. Well, now 825, but the stock market's up almost 2% this morning. And that's all on news that was released over the weekend. So, in the past, you didn't really have to pay attention to the news over the weekend, right? They were rehashing the old week. There wasn't a lot that was market moving. Right now, and just following that Kobiesi letter, like if you're on Twitter or X, follow Kobiesi letter, click on it to receive notifications. And when they tweet something new, you get a notification. A few times throughout the weekend, I'll get an alert. I'll click on it, see what's going on, scroll the last two or three posts. That way I feel equipped of what's going to happen on Monday. So you could almost predict over the weekend that the mortgage market and the bond market would improve a little bit, and we're seeing a little bit of improvement this morning. And you could predict that the stock market was going to improve just based on what happened over the weekend. And so it's just in a different time now where you're in this 24/7, 365 news cycle where things actually happening over the weekend. So I'm going to share my screen here with you guys, and we'll kind of dive into the data. But make sure you're following along in advance of Monday at 9 o'clock in the morning, so you know what's likely to the market's likely to look like, when we hit the ground running on Monday. Um, okay, so um, I posted these three articles in the chat earlier. If you guys want to look in the chat and grab these, if not, just message whoever you work with on our team. We'll get them to you. But The first was a really good article from last week I found that talks about the relationship between oil prices and mortgage rates. Um, and it kind of has a what does it mean to homebuyers spin? That was a really good article. Um, the second one I've got here. So what caused the markets to really sell off on Friday was the European Central Bank, the ECB, which was basically like their version of our Federal Reserve, projected that they would have three rate hikes, not cuts, but they would have hikes to interest rates this year. And every country in the world, it's a very global economy now, is competing for the same dollars. If the ECB is hiking interest rates, what's likely to pressure the Federal Reserve to do? Maybe hike interest rates. And so this is a good article that really talks about why did the market sell off so much on Friday. Um, and then we talked a lot about Chris Waller. So incoming, Fed chair, likely Waller, was on CNBC last week. He's generally speaking been viewed as more dovish, which means more likely to cut interest rates. But he took a little bit more of what would be called a hawkish tone on this interview, which means that he says that like rate cuts are not on the immediate horizon. Um, he's going to take more of a cautious stance. So I posted all three of these articles in the chat. They're all very informative. This is an interview to our articles. I've got two other things here that I haven't linked yet. But this article literally was posted within the last 2 hours. Dow futures jump, oil prices dive as Trump cites productive talks. But then Iran denies it, right? And so how much of this news can we rely upon? And the reason why you're seeing so much volatility is like every 2 hours, news comes out and it's not always the same. Like the story could change. And so, a few hours ago, there's information that we leak on our side, which is peace talks are productive. The market likes that. Maybe the Strait of Hormuz opens up. Maybe oil prices come back down. That's good for inflation. And then 3 hours later, the Iranian response might be like, we disagree, and we're firing off some missiles at a ship in the Strait of Hormuz. And what would that cause oil prices to do? It caused them to spike. And so you have all this volatility right now because the news is coming so fast. So like right now this morning, oil prices are down pretty significantly. That's good news for mortgage rates. And the stock market's up 825 points, after the open at 9:30. So stuff's happening really fast. I think for us, it's good to follow the fast news of like the rapid changing of information, the ebbs and flows of the market within the day. I don't think that's necessarily good for our customers. And I think for our customers, it leads to lots of stress. So um, I think it's important for us to kind of take in the news, decipher what's happening, formulate an opinion, and then share that opinion. But our customers aren't looking for us for real-time news. Like that would be very stressful and confusing to them to like if all of our people across country were like, bad news, rates went up today. Good news, rates went down tomorrow. Bad news, rates went up Tuesday. Good news, rates went down Wednesday. I think that's accurate information, but a message that people that aren't in the industry would have a hard time following, and it would lead to stress. And so we're not trying to communicate that rapidly to customers, but intake it rapidly, I think, is important. Um, so I want to share a couple charts and graphs here because mortgage rates have gone up, and they've gone up about 0.5% since the start of the conflict in Iran. I'm going to share the chart of the 10-year Treasury. So this chart is starting, March 2nd. You can see the increase in the 10-year Treasury, 10-year bonds, 10-year yields. You can hear it called different things. So this has a direct impact on mortgage rates. And you can see that the 10-year went from around 3.95 up to close to 4.4. So 0.45% or 45 basis points. That's pretty directly correlated to an increase in interest rates from around 6 to around 6.5. Generally speaking, we've seen about 0.5% increase. There's obviously bad news with this, right? Rates are higher. Affordability gets squeezed a little bit, but to what degree? So we've shared this chart before, and we shared it as a way to show people that homes are moving towards more affordability, right? Well, now I'm sharing this because things are a little bit less affordable. And so let's take a $400,000 sale price, um, roughly $2,400 a month right here as the principal and interest payment, $400,000 sale price, 6% interest rate. That was, let's say, last week of February. 3 weeks later, rates are 6.5, 25, 28, about $125, $130 a month difference. So, um, it's I feel like do you guys think that when rates went from 6.5 to 6, did the floodgates completely open and it became a great seller's market and every house was multiple offers and it was this booming market and all the buyers that were on the sidelines the last couple of years came rushing back in? Like, no, they didn't. As much as we all would have loved for that to happen, it
in
really
Avatar.
didn't. And it really didn't because, people either had made their mind up that they were on hold and not super active. They were waiting for the market to settle down or whatever they were waiting on. Um, and it was also because $125 a month probably wasn't going to make a difference between buying and not buying, right? And so now that we're facing the opposite, I wouldn't expect the same thing to happen from a does it make sense for me to buy financially standpoint. 100, just like $125 a month reduction in your payment probably didn't make you a buyer when you were on the sidelines. It's probably not financially going to push you off to the sidelines when you were actively looking at houses. But the emotions can change that. And I think I shared last week an example of a customer we had that first time home buyers, super qualified, found the perfect house. And then as soon as conflict in Iran starts, it's like, pump the brakes, right? And so I think what we have to do right now is make sure people understand, just like we did when rates were drifting lower, what the impact was to your payment and affordability. Now that rates are going higher, what's the impact? Um, and I think people will make poor and emotional decisions, maybe to pull out of the market, maybe to take their house off the market. Like they might call you up, hey, I'm taking my house off the market. I'm stressed out about, about what the conflict in Iran could mean to, the real estate market. I think people weren't making the financial decision to buy as much as we might have thought they would have when rates were going down. I think they're probably going to start making the emotional decision to pull back with rates going up. And so I think that's where the education piece comes in. Like sharing data like this, I think is really important. Um, and if people pull out of the market, which I know people will because of the emotional decision of doing that right now, that leads to more opportunities for other buyers, maybe, less competition. So, but I think it's important to keep it in perspective, what the difference in rates means both before when they were drifting lower and now, when they're drifting higher. Um, I'm going to ask an opinion and see what you guys think. So let's say the war ended tomorrow. Okay. Let's just, obviously that's not happening, but like if conflicts ended, if the Strait of Hormuz goes back up, if oil prices go back to 65, $70 a barrel, how long do you all think it would take for mortgage rates to get back to 6% to where we were 3 weeks ago? What do you guys think? I'm just
Three to
curious to
six
get a few
months.
opinions. Okay, Duba's got 3 to 6 months. Okay, and what else do you guys have? All right, so 4 months. All right,
Me.
okay, 6 months, 3 to 6 months. Okay, I think we're all on the same page. I would agree with you guys. It's not going to be fast, right? And so I think that's something that even if we get good news overseas and the conflict slows down and oil starts flowing and um, geopolitical tension is less, it's going to take some time. So let's talk about the life cycle of like how long it takes for inflation to creep in the system and then how long it takes for inflation to cool. So there was a report released last week called the Producer Price Index, or the PPI, and there's three inflation reports that are released every month. The PPI is the least important of the three. The CPI, the Consumer Price Index, is very important, but second. And then the PCE, the Personal Consumption Expenditure, is the most important. Um, the PCE and the CPI, and you've used those terms a lot, are measures of inflation at the consumer level. PPI is inflation at the producer level. And there was some instances last year during the kind of increase in tariffs, like the tariff battles last spring and summer, where PPI increased, but CPI didn't increase, and if it did, it was not to the same degree by any means. And what was happening last year was the producers, and so think like Walmart, right? Biggest retailer in the world, the cost of goods coming into Walmart might have cost Walmart more. They weren't passing those costs on to the consumer. It was just eating into their profit margins, right? If they passed it on to the consumer, the CPI would have gone up. And so last week there was a really hot PPI report, a little bit unexpected. I think the market took it with a grain of salt. Maybe wait and see what happens in April if it remains elevated. But PPI is the first sign. And so what I think we're going to start to see is oil prices went up, cost of goods and services coming into the producers like Walmart are going to go up. What's remained to be seen, and we won't know this, I don't think, for 60, 90, 120 days, is what's being passed on to the consumer, and does consumer inflation move higher? And that's why everybody who answered, it's going to take a few months for rates to come back down. I think the market's going to take a really big wait and see approach to see what's the impact of this going to happen. If we look last year, during the tariff battle, so let's go back the last 12, or we'll do 12 months. So this is the 10-year treasury, and so last April is when rates started to shoot higher, and the bond market, the 10-year treasury shot higher from early April here through the middle of May. Right around May 23rd is when we paused the tariffs. There was remember that 90-day pause. And so in 45 days, rates shot higher. How long did it take for them to get back down in this level? Really until about October, right? So from May through October, so that's 4 months. That's how long it took for things to drift lower. So a really fast increase in rates and then a slow drift lower. And so what's happening right now, end of February through late March, 3 weeks, right? Rapid acceleration in interest rates, 6 to 6.5%. How long is it going to take for rates to drift back lower to 6? It might be a line like this, it might take 3 or 4 months, right? And so that could be August or July or September. And so I think it's important that when we're talking to customers, we'll probably have people that, like I had a customer over the weekend, I've worked with them for many, many years, and they're asking about interest rates. And I'm like, yeah, this is going to be a fun conversation because a few weeks ago, we were at 6 as they're going under contract, but rates are 6.5, right? We can't set the expectation that they're going back to 6 because it's not going to happen in the time frame they're under contract. And for people that we're actively working with, it's probably not going to happen until they find a house and close, right? It's rates are just not going to get there that quick. But I think it's good to have those conversations now and then share information like this so they understand what that means. Like, here's the information, here's what it means to you, is the kind of conversation that I think. Let me try to get whoever's muted here real quick.
I can head over there. I want to make sure somebody's going to be home that we can see.
1 second, guys. I can't.
Absolutely.
Trying to find who that is.
Make sure enough. Actually, I'll be on my way.
Let's see. Where did they go?
It's Evelyn Alcia.
Okay, Evelyn Alcia. Evelyn Alcia, if you can mute yourself. I don't even see her on here, Aaron.
Oh, perfect. That's my mom. So they'll be coming.
Gotcha.
That's what keeps popping up.
Here's what we're gonna. I'm not sure if anybody knows Evelyn, but
I do.
Okay, cool. Okay. So I think it's important to have those conversations now, right? Just to get that out of the way. Like, it's rip the Band-Aid off. And this is more of a lender thing than you guys, but have the conversation now, rip the Band-Aid off, make sure people understand, reset expectations, and then get them re-engaged. And if rates drift lower, then great. But I think it's going to be a while. In fact, I think rates could get worse before they get better to some degree. Like, we haven't seen the impact of higher oil prices on inflation. In a month or 2 or 3 months, there might be a CPI or PCE report that comes in that shows inflation spiked, because of what happened, the last few weeks, that could cause rates to tick up a little bit. I don't think you're going to see rates, get to some crazy number, 7% or something like that. To me, that goes back to it's an election year, and the president knows that. And anytime rates start drifting higher, there's a level, just like with tariffs last year, where it's like, okay, we've got to do what it takes to bring interest rates back down. But I don't think it's going to get better fast, and it could get a little bit worse before it gets better, I think. So just something for us to prepare for. So again, sharing data like this, I think, is helpful to put it in perspective for people. I've got another chart or two here I wanted to share with you, and this is really good news. So this is going to keep rates below 7%, even if inflation spikes, in my opinion. So this is the spread between the 10-year Treasury and 30-year fixed rate mortgages. We've talked about this data in the past. It's been a few months, but you can see in 2024, the top line, mortgage rates were around 2.25% to 2.5% above the 10-year Treasury. Last year it was like 2.25, drifted to 2, and this year we're under 2%, right? So we're, in that 2% range. And so if I go back to the 10-year Treasury chart and we look here, and the 10-year Treasury is 4.3, 2% above that, 6.3, a little bit pretty close to where the range of interest rates are. So this is really positive news, and I think this will keep rates from ballooning like north of 6.75 or 7. And this guy's a really good follow on LinkedIn, Logan. He's the lead analyst for Housing Wire, which is a kind of a more mortgage, but a little bit real estate publication. Really good follow. And I screenshotted this. So if the 10-year Treasury is where it is today, and mortgage spreads were where they were in 2023, rates would be 7.6%, with 2024 spreads 7.3, 2025 7.1. So that spread of the mortgage rates over the 10-year Treasury, putting rates in the mid sixes, is still a positive sign compared to where rates would have been a couple years ago. So still good news, but again, we've got some bad news within here with rates ticking up. If you guys want copies of any of these charts, just again, message whoever you work with on our team. I think in particular, this one is something, we'd love to get to you guys, and it's a tool you can use. Good social media content as well. I feel like this would be a great Instagram green screen reel with this chart behind you with you talking and pointing. That's kind of how we intend to use it. Okay, so let me jump back in here, and I just want to jump back into the bond chart real quick, and we'll review that with you guys and wrap it up, because we do have some good news today. Although, again, it's a little bit muted. So on Friday of last week, and I've mentioned this a couple of times, we had about as bad of a day as we've had in years. The bond market right here was down about 85 basis points, which is about 0.25% in interest rate. Today, if you can see this green candlestick, we got about half of it back. So the bond market's up 34 basis points today. That's almost 0.1% rate improvement this morning. So that's really positive news. We talk about these lines here, this blue line here and these black lines that are all called technical levels. The bad news on Friday is we broke below this blue line, which is called the 200-day moving average. And so that's a bad signal that rates are going to shift a little bit higher. The positive is we hit this support level here and we bounced higher. And then that was followed over the weekend by some potentially positive news out of the Middle East. But, who knows, what'll happen with that. But we've seen some positive news, a little bit of a rebound today after what happened Friday that was really poor. As far as the week ahead, on the economic calendar, there's not a ton of data that's going to be market movers. All this stuff is kind of standard, normal. There's no jobs report. There's no inflation reports. The next jobs report will be next Friday. So what's going to move the markets this week? It's going to be what's moved the markets the last few weeks, which is news overseas, out of Iran. Are ceasefire talks positive? Are they progressing? Is oil coming down? Those are the things we want to watch. But we've started the week off on a positive stance. I will just caution us that if we look over the past few weeks, Last Monday, things were positive. Last Tuesday, things were positive. The positive news from the weekend wasn't followed through. Wednesday, Thursday, Friday was bad, right? And so we're starting this week off positive, but we need that news momentum that's positive for the bond market and for the real estate market to continue as well. So that remains to be seen. But if you guys don't follow that Kobe letter, it's my favorite thing I follow online. It's on Twitter, X. Make sure you guys follow that. That's the best place that I go to for real-time news. That's not like politically slanted one way or the other, just financial information, hard news, accurate without any type of spin, which is hard to find, most places online. Okay, guys, we'll wrap it up there for the day. Thank you for joining us today. Really appreciate you guys as always. And if there's anything we can help you with, let us know, and we will see you guys next Monday. Thanks, everybody.